Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, CFP Tim Stearns. Tim, we always appreciate the guidance, helping us to understand our money, clarify the financial world, and provide a little bit of perspective on what we need to be doing with our money to achieve our financial goals. Always a pleasure. Welcome back.
Peter, thanks for having me.
Always a pleasure. And Tim, we're seeing a lot going on in the financial world. I mean, we know that we're going to have good days and bad days, and times are going to change and ebb and flow. But it does seem like we're seeing some challenging conditions globally, obviously, and then in the market as well.
Exactly. I mean, you turn on TV, that's all they're talking about is all the upheaval overseas. You have that going on, and then you have things going on here with inflation being, uber high, the highest it's been since 1982. So yeah, there's a lot going on and stuff that we need to kind of batten down the hatches and get ready for.
Yeah. Well, even in good times, and actually, Tim, probably especially in more challenging times, if we stick to some of the fundamentals for long-term financial success, we can see progress kind of regardless of what the environment is around us, right?
That's a great point, Peter. I mean, we talk about that a lot in our classes that we're doing for retirement, that, try to get some uncorrelated assets in there in your portfolio so that when there's times of upheaval, you are able to, there is a safety. When I first got in the industry in 1994, the safety was bonds. That's not truly the case anymore. Bonds actually lost money last year. So what we're trying to tell people is look for other products, or areas that you can put money into that's not going to be beholden to someone invading a country, the Fed raising rates, that type of thing that can adversely affect your portfolio.
Well, today on the program, we are going to get back to some of the fundamentals of long-term financial success. We know that the world around us sometimes does seem to be a little haywire, and unfortunately, market volatility can cause us to panic or make mistakes or act out of fear. But again, if we stick to these fundamentals, good times, bad times, or anywhere in between, we can continue our financial progress and path towards success. So we'll be talking about some of those on today's program, just as a reminder for you, ladies and gentlemen. And if you would like to get a plan put together that keeps these financial fundamental principles in place, then give Tim Stearns a call for that Protect and Grow plan. It is your opportunity to sit down with a certified financial planning professional, a CFP. Tim Stearns does offer his time and his guidance to help you design and implement your individual Protect and Grow plan, taking into account many different aspects of your situation, your goals, and helping you review and analyze the risk that you are taking, the fees that you're paying, the taxes that you may be liable for, to design an optimal plan for your financial future. Now, similar plans can go upwards of $1,000 to several thousands of dollars for similar plans, and all of the detail and work that Tim Stearns will go into with you. But Tim does offer to put this plan together for radio show listeners at no cost, waiving all fees associated with the plan design. And that Protect and Grow plan will help to increase your financial confidence into the future. So pick up the phone and give a call, 800-640-2256. That's 800-640-2256. If we are going to take it to the basics, number one, Tim, invest early, invest often, and invest as much as possible.
Exactly. One of the things we talk about, with our clients and with our potential clients is, dollar cost averaging really helps, to get your money in there and just force savings. And before you know it, you have a little nest egg built up. So no matter what, my wife and I used to kid, we give till it hurts, right? I mean, basically the joke there is that, after a while it gets if you don't have the money, you can't spend it. So I would tell people, make sure you're funding your 401ks, other investments out there, do the IRAs, the Roths. You have right now up until April 15th, you can put in money still for last year, 2021 and 2022. So there's some opportunities that I hope people aren't missing out on, by getting their money working for them.
It's a simplified kind of approach here. When we say invest early, invest often, invest as much as possible. Yeah, it seems simple enough to those who are doing it, but money is really behavioral, Tim. And it's like if somebody started with this process very early on in their career, it does seem simple to continue that behavior. But what I've noticed anecdotally is that if somebody tries to get into this later, a lot of times it's, well, I've got a little bit of available money. Let me go ahead and catch up and invest it and stash it away. And they try to do it all in one chunk and then maybe don't do it for a while. And then they build up another chunk and throw that at their investments. It effectively does not accomplish the same thing, does it?
No, especially if they're buying it at all-time high in the market. You're not getting as much as you could have received if you were dollar cost averaging. And that's been proven that if you can do that, it's going to, make it so that you're building up the nest egg all the time. Market's low, market's high. It doesn't matter. You're putting money away for that rainy day when you're going to need it. And that rainy day could be, shooting for the stars that you want to go on that trip you've always wanted to do with your spouse, or retirement. So these are the things that we try to tell people: stay disciplined, stay systematic with it. That investing is only going to behoove you down the road, especially when you're retired.
Another anecdotal statistic I heard recently, I don't actually remember the exact number, but it was surprisingly high. The number of people over the last couple of years that have retired unexpectedly or not on their preconceived timeline. Tim, if we're investing early, often, and as much as possible, even if retirement doesn't quite happen as we exactly planned it, we are going to be better off and in much better shape.
Exactly. Boy, with COVID, we've seen a lot of people, they don't want to work anymore physically. Mentally, it's weighed on them, or work has just gotten to the point that they can't do it anymore. We had one client that had 4 bosses in 1 year, and he just had enough. And the nice thing about that was that we had done an income allocation plan for him to go in a couple of years, and we moved everything up, and God bless him, it worked. So we were able to do it. We also had another client that got sick that needed to move that up, and him and his wife came in there a couple different times to kind of rerun the numbers, make sure that we had it right. It's kind of like a carpenter, right? Measure twice, cut once. Making sure that we had those numbers wired, because and their life is better. Now that he's not working, and he can just focus on his own physical health and then therefore his mental health too.
Tip number 2 here, financial fundamental principles. Tim, don't get sidetracked or distracted by the news of the day. Continue the course, stay the course with your long-term plan.
Well, no one is going to get rich off of trying to time the market. There's different plans that we're using to look at different algorithms and that type of thing. But at the end of the day, stay tried and true. If things are, when the normal investor sells too early and buys too late. So if you're fundamental about it, where you're just always investing, that takes the guesswork out of it and just makes things, in my mind, better. And, you're going to have you'll build up a nice portfolio.
Well, certainly, Tim, with what we have seen to begin the first quarter of this year, things around the world, current conditions, as well as the effects and impacts it's had on the market, I think that one could easily get a little sidetracked or distracted or veer from the fundamentals of the plan. But having that plan in the first place is going to help us keep accountable to the job that we need to be doing, and then kind of give us the map and the course of where that's going to lead us.
Having a plan is, I think, absolutely huge. Having a goal. I mean, whether you're trying to lose weight, get in a better shape physically, but having a goal that you can hold yourself accountable and your spouse. I mean, I think that's, you can't put a price on that, as they say, to have an idea of what you want to do. And by doing so every single month, you're still staying on it, it feels good. And after a while, you start to realize that you're on the right track.
Tim, next on your list here, I find this conversation very interesting. In fact, much shorter list here of these qualities, but you find it important to remind people and for investors and savers to achieve their goal to keep in mind what we actually do with our money, and then in turn, what money can do for us.
I mean, basically, what can money do for you? You know, it can grow. It could be safe. You know, you could put it in a bank and be safe. It could be liquid in a bank that you could go buy a car, you know, what have you. And then obviously one big thing, especially with retirement, you can create income. And I think that's really what we're trying to do. You know, we always talk to people about, if you retire in March and April, what is your first check? Where is that coming from? And that's the way to do it.
And we need to understand that when we receive money, Tim, we pay bills, we pay taxes, we spend, and we save. And those first three things, when we do those things, that dollar is gone forever. It's only number 4, what we've saved, that has the ability to do those things that you've talked about, and then recreates in retirement our ability to continue to be able to do those first 3 things with confidence.
Right. And unfortunately, you know, save and invest is usually the last thing that we're doing, right? You're paying taxes, you're paying your bills, which is very important. And you're spending, you're buying things that you need, groceries, the mortgage, you know, utilities. And then that last thing standing there is you're saving and investing, you know, and you know, you need to make sure that you invest, you know, and keep on that plan all the time, you know, and by doing so, you'll actually help yourself in the long run.
And you spoke about the importance, the value, the benefit of dollar cost averaging. Another fundamental principle that oftentimes does get overlooked, Tim, rebalancing along the way.
Rebalancing a portfolio is huge. You know, I see a lot of people having drift in their portfolios when they come to see us. Even with the market being topsy-turvy like it's been this year, we see people coming in with way more in stocks than they meant to be, or better yet, that they don't even realize. So when we do a risk analysis, they go, oh my gosh, I didn't realize I had 80% of my money in the stock market. No wonder I've really taken my bumps and bruises this year. So we make sure that we explain to people, you know, you still have to stay, you have to rebalance and make sure that your portfolio, which, you know, the bonds didn't do a darn thing last year, that you still have some money over there if you're going to be using a true portfolio.
And Tim, there are a few different types of rebalancing that can actually help us achieve several benefits in our portfolio and in our financial progress over time. Rebalancing can be regular and routine. It can be strategic. It can be tactical. Let's talk about a few of the things that rebalancing does help us to achieve. Rebalancing routinely helps us to keep our risk in line with our risk tolerance over time.
Back to my point, though, I mean, with a 13-year bull market, we have people invested way more than they want to be in the stocks, and with that comes a lot of risk. And you know, if I'm in my late 60s, early 60s, and I'm getting ready to retire, or you know, I can see the light at the end of the tunnel, you don't want to be like that. You might want to work some uncorrelated assets in there, you know, things like annuities, life insurance that have long-term care components to it. Those are the things that don't get affected by the market or things overseas that I think would behoove anybody to have a good plan, you know, and staying to it. But that comes with having a plan.
And again, a lot of times, Tim, this is overlooked. I think that one of the main reasons is because the way that the majority of us have saved the majority of our retirement dollars has been this sort of out of sight, out of mind approach. The benefits of the 401k. We've had whole episodes where we've talked about how important and how valuable the 401k can be. But we've also pointed out that the downfall or the downside of the 401k is the fact that it often gets ignored with the routine maintenance that would need to go along with it.
Well, and if you want a quick answer on that, I mean, you could do a target date, right? If you're under 59 and a half, you're beholden to what they have in those plans. So maybe take the gas off the pedal for a little bit and go into a target date like 2025, et cetera, where you're not taking a lot of risk. If you are over 59.5, give us a call, because you can open up your world to all kinds of things that would be better than the rank and file mutual funds that you have inside your 401k.
Again, if you'd like some help and assistance, if you would like some oversight in your account, monitoring on a routine basis, certified financial planning professional Tim Stearns, CFP, is here as your resource, ladies and gentlemen. You are welcome to give a call and set up a time to speak with Tim, ask a few questions, find out a little bit more about the opportunities that you may have available to help you get your money to work a little harder. And of course, Tim does offer to help design that protect and grow plan, or to review your current plan and make sure that you are doing the best things with your money to achieve those goals that are important to you. Pick up the phone and give a call, 800-640-2256. That's 800-640-2256. For the detailed review and analysis, that forensic financial deep dive Tim will do into your accounts, your investments, your retirement portfolio. Similar reviews can go upwards of $1,000 to several thousands of dollars, but Tim Stearns makes this available with no cost and obligation to radio show listeners. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256. Tim, rebalancing can help capture gains along the way as well. That's more of that opportunistic rebalancing. There are certain times where a simple rebalance will help us to preserve more of the gains that we've already made, and maybe move a little bit of that off the table within the portfolio.
Right. And if you're able to do that, I mean, you can take some of the house money, or play with the house money, as they say. Maybe take off your principal and put it into something a little bit less risky when the market's at an all-time high. So yes, there's definitely an opportunistic rebalancing that should be going on right now. If you in a 13-year bull market, I've never seen anything like it in my 27 years. So now is the time to take some of that money off the risk area.
And then, Tim, our lives are going to change and evolve over the years, over the decades. Our needs from our money change, and we should rebalance along the way to reflect that evolution as well.
Exactly. I mean, when you're in accumulation, like in 2008, it's 14 years ago, we were a lot younger then. So taking our bumps and bruises in the market, losing money didn't feel good, but the good news was it was 14 years ago. And now we can't have that. So now we're kind of in a preservation mode. We call that the red zone in our office. The red zone is the most important time, to be preserving money, but you also can't take your foot totally off the gas, because you need to stay up with the silent thief, as we call it, inflation. And then, the last part of it is, when you're finally retired, what does your distribution look like? How are you going to take out money to live on, and how much, and from where? And those are all parts of the plan that we would do for people. And
again, if you would like help and assistance, pick up the phone and give a call to Tim Stearns, certified financial planning professional. He is here to help and assist with your planning needs, ladies and gentlemen, to make sure that your dollars are working in the most optimal manner possible to help you achieve those goals. 800-640-2256. That's 800-640-2256. Tim, you hit on this next group of topics here, which is just make sure that you are cognizant and aware of the different phases that we have with money, and that your portfolio reflects the current and future phase that you are in or will be in.
Well, when you first get out of college till about, I'd say, late 50s, early 60s, you're in an accumulation. You're taking more chances because you have a timeline that works with that. Then as you start to slow down and look around, and as they say, smell the roses, right? You're starting to realize, this is what I have. I'm a net seller of assets once I shut down this job that I have a 401k with. So now we have to preserve, and then lastly, you're looking at distribution. How are you going to pay your bills? That all comes through an income allocation plan. And then, obviously, and I hope this is everyone's problem, that you have a legacy area, that maybe you want to leave some money to the kids, the grandkids, what have you. This all needs to be planned out, and the income allocation plan answers, all those questions.
And Tim, you've talked before on the program that not every advisor really has the same focus in those different areas. And in fact, your advisor probably should have a focus in the specific area that you are in or are moving into.
Well, a lot of the times in here, we'll see something that another advisor did where they're doing an illustration and assuming X amount as the return per year. And I ask people in our classes, especially, do you ever had a portfolio that always went up 8% a year? Always? That's not a thing, you know, and we have to be real about what the market does. It goes up sometimes and it comes down sometimes. And how do you figure out how you're going to live? You know, if you're being too aggressive with the returns, it's going to make you look great, but down the road, you might find out you were completely wrong. And my Lord, I would hate to learn that if I'm in my late 70s, early 80s. Am I going back to work then? Am I going to live with my kids? Income allocation plan, we go real low on what the return we're trying to get for people. We want to assume, I'll say, the most conservative or worst approach, you know, that, you know, this is money that we need to make last, and we're not going to try to grow it by leaps and bounds by hitting home runs and doing cryptocurrencies and all this crazy stuff that's out there. We're just trying to, you know, hit singles and get the retirement just right.
Last week on the program, in fact, Tim, we talked about the regularity and the magnitude of downsides in the market, previous downturns in the market, what it meant, how many have there been. We went through a lot of different numbers, but one that I was shocked by, over the last 21 years, from January of 2020 all the way through December of 2021, the average cumulative compound rate of return of the S&P was just under 5.75%. The cumulative compound rate of return of the S&P over 21 years, 5.75%. That's bad enough. But if you've got a plan for retirement, Tim, that depends on an 8% or a 10% or a 12% rate of return, and we see the next 21 years, anything similar to the last, that's really going to put you way behind the 8 ball there.
Right. Well, one of our slides in class is 10-5-3. And the 10% is what in 1994, what we were assuming when I got in the industry, a stock would do. 5% is what we assumed bonds were doing. And then remember, these days, when a money market would throw off 3%, those are gone. And you have to be, you know, change with the times and realize that things are not the way they were. And you have to be very conservative when doing an income allocation plan, so you don't find out the wrong time that you don't have enough money.
Now, I don't think that it's ever too early to start thinking about retirement planning, how your dollars are going to begin generating that income. If we started that on day one of our working career, we would probably finish that working career a lot sooner. But Tim, that income allocation phase, that different fundamental shift in planning really becomes essential around that preservation and especially in the distribution phase.
It really does. And you need to make sure that you're staying on it. You know, we always meet with people and after they become clients and reassess where we're at. Are we getting the accomplishment of the goals that we wanted, and making sure that, you know, people are staying on track. If they're not staying on track, then shame on all of us, because we need to do that and make sure. I see people who have a financial plan this thick, you know, a couple inches thick, and they've never even opened it since they got it from their old advisor. These are things that need to be revisited every year because things are changing by the minute.
A 3-inch thick financial plan, Tim, and then often it does not include any type of written retirement income plan. Nothing that can give us confidence through downtimes in the market once we are retired.
Right. And you know, one of the jokes we always make in class is I say, hey, I want to come build your house. And you ask, well, let's see blueprints and prices. And I say, no, we're just going to wing it. People are doing that, you know, and they're just kind of getting through it. And hoping for the best is not a way to retire by any stretch.
Well, Tim, you've talked about this book, Income Allocation. That's been a valuable resource that many listeners to the program have taken you up on the offer to receive free of charge, complimentary, but many, many more still could find value and benefit in reading this book. Now, the strategies described in this book work best for those who have saved $1 million plus, but you make a special offer on this program, limited time availability here. We've been talking about this book for a while. You need to get your hands on it, ladies and gentlemen. But Tim, for the first 10 callers to the program, you're going to make a copy of that book, Income Allocation, available. if they have saved at least $500,000 for retirement, because those that are building and working their way there, they would benefit from having this knowledge as well.
I think everyone benefits from the book. The book talks about, having stop losses in your portfolio, investing in institutional type platforms instead of the rank and file mutual funds, Medicare, Social Security. It covers the whole gamut, just like our class does. And thankfully, we're in person again, and we're teaching our classes at Roosevelt and Chicagoland area. People are doing Zooms from all over the United States. These are the times to, learn. You'll take away at least a couple, as we say, nuggets that have taught you something that you can use in your retirement.
Well, we've talked about some fundamental principles for long-term financial success, the financial foundations on this program. Just a gentle reminder, ladies and gentlemen, that regardless of the economic conditions and the environment in the market, you can make financial progress if you have a long-term vision and stay consistent with what you are doing to achieve your goals. Investing early, often, and as much as possible. Staying out of debt. Debt can be a great tool, but it's more often, unfortunately, misused and can get people in trouble. Don't get sidetracked by the news of the day. Don't get distracted. Stay the course and make sure that you continue on with these fundamental financial principles. Understand what we do with money and then what money can do for us. It can grow. It can be safe. It can be liquid. It can provide an income, but any $1 is typically a terrible multitasker. And in order to find the right investment for you, you got to decide which of those goals is the most important. Dollar cost averaging, rebalancing, understanding the benefits of certain retirement accounts, and understanding the different phases of money so that your plan reflects the phase that you're in and the phase that you want to move toward. All of these are important factors in your financial progress. Tim Stearns will help you put a plan together, a forward-looking, proactive, optimized plan, that protect and grow plan. For listeners to the program today, he makes that available to you with no cost, no obligation. And also, for the first 10 callers with at least $500,000 saved for retirement, you can reserve and receive your copy of the Essential Retirement Planning Strategy Guidebook, Income Allocation. Just give a call now, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, it's always a pleasure on the program each and every week with you. We appreciate your guidance and insight and sharing the tips that we need to know to make our money work harder for us.
Thanks for having me, Peter.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.